It has begun. The United States national debt didn't cross $39 trillion last month because Congress decided to spend more. The U.S. didn't add $2.77 trillion in debt over the last 12 months because of one bad policy decision. Net interest payments didn't triple from $345 billion to over $1 trillion per year in 5 years because the Fed was caught off guard. And the IMF didn't warn the world on April 15th that global public debt will breach 100% of world GDP sooner than anyone forecast because it wanted headlines. All of that happened because the math finally caught up. Gold is trading at $4,238 an ounce today. That's down roughly 10% from its $5,199 all-time high hit on January 29th of this year. Every mainstream analyst is telling you the gold rally needed a pause. Every talking head on financial television is explaining why the move has come too far too fast. Every brokerage note is advising clients to wait for a better entry. They are reading the wrong chart. Because underneath the 10% paper correction, the single largest debt crisis in human history is accelerating, the U.S. added another $120 billion to the national debt in the 3 weeks between March 4 and April 3rd. The average interest rate on marketable treasuries has more than doubled from 1.5% to 3.37% in 5 years. Net interest already consumed more than defense spending for the first time in American history. And the Penn-Wharton budget model, the nonpartisan fiscal analysis group at one of the most respected universities in the country, just said the true fiscal gap, including unfunded Social Security and Medicare obligations, is not $39 trillion. It's $100 trillion. That's what's happening right now, not a gold correction. The accounting truth finally arriving at the door of the most indebted government in human history. Welcome back to the macro mirror. In this breakdown, I'm going to show you exactly how the debt spiral works, with real numbers from real Treasury reports as of this week. I'm going to walk you through why the Federal Reserve has almost no good options left and why the choice they make will determine the price of gold for the next decade. I'm going to explain why central banks around the world have been quietly buying gold at a pace not seen since Bretton Woods collapsed. And I'm going to give you the 4 signals that will tell you whether the next leg in gold is weeks away or already underway. Quick favor before we go further. Subscribe. If you want clean breakdowns when macro pressure like this reaches the critical point, not hype, not cheerleading, just the mechanics, hit the bell. Debt spirals don't announce themselves. They announce themselves through the gold price. Let's get into it. Let me start with the numbers. Because every macro analysis that doesn't start with numbers is a guess, and guesses don't protect capital. As of April 3rd, 2026, the U.S. national debt reached $38.98 trillion. By the time you're watching this video, it's almost certainly crossed $39 trillion. The debt has increased by $2.77 trillion in the last 12 months alone. That's an average of $7.58 billion per day, $315 million per hour, $87,000 per second. While you watch this video, while you sleep tonight, while you work tomorrow, the debt compounds at a pace no American adult has ever lived through in peacetime. The average interest rate on the total marketable national debt is 3.365% as of March 2026. 5 years ago, it was 1.4999%. That means the government is paying more than double the rate on debt that has grown by $90 trillion over the same period. That's not a budget problem. That's a mathematical cascade. Higher rates on a bigger pile produce interest costs that grow faster than the economy can. And the numbers now prove it. Net interest payments for fiscal year 2026 are projected to exceed $1 trillion, nearly triple the $345 billion the government paid in 2020. In the first 3 months of the current fiscal year alone, net interest hit $270 billion, surpassing defense spending for the same period. The Peterson Foundation calculates that over the next 30 years, the U.S. government is projected to spend nearly $100 trillion on interest alone. Not on programs, not on infrastructure, not on defense or healthcare or research, just on servicing debt that was spent by previous generations. That's what debt spiral actually means. It's not a slogan, it's an accounting identity. When interest on debt grows faster than the economy, the government has to borrow more just to pay interest on what it already borrowed. And every time the Treasury issues new bonds to cover that gap, the bond market has to absorb more supply, which pushes rates higher, which compounds the interest burden further. Here's the Penn-Wharton budget model's view, and this is the part that should genuinely unsettle you. Their model puts the true U.S. fiscal gap, accounting for both explicit debt and implicit liabilities in Social Security and Medicare, at close to $100 trillion. Their previous analysis estimated that without major policy changes, Treasury debt becomes unable to roll over its accumulated obligations within roughly 20 years. That would force either an explicit default on interest payments or, and this is the key phrase, an implicit default through inflation. Read that phrase again. Implicit default through inflation. That's not a fringe doom prophecy. That's the nonpartisan quantitative estimate from Penn Wharton. And implicit default through inflation is the three-word description of exactly what gold is priced for. So here's the first lesson. The gold market isn't pricing a scenario anymore. It's pricing a decision the government will be forced to make. They cannot grow their way out. The math doesn't allow it. They cannot cut their way out. Entitlement politics doesn't allow it. That leaves inflation. And inflation is the one outcome gold has priced correctly in every debt crisis in monetary history. Let me get more concrete about why the Federal Reserve has almost no good options left. Picture the policy trap the Fed is currently trying to navigate. March CPI came in at 3.3%, well above the 2% target. The Iran conflict has kept oil elevated and inflation sticky. The Hormuz blockade remains partially unresolved, adding a persistent energy cost floor. Kevin Warsh is going through Senate confirmation to become the next Fed chair, and his hearings have been explicitly about a new framework to address persistent inflation. Fed independence is genuinely in question for the first time in a generation, with the Warsh nomination itself politicized in ways that previous chair confirmations never were. Now look at the Fed's actual policy options. Option 1, raise rates further to crush inflation. The problem? Every 100 basis points of additional rate hikes adds roughly $400 billion per year to the government's interest bill on debt that refinances over the next few years. The Fed cannot aggressively fight inflation without causing a fiscal crisis. That's not an opinion. That's the math of $39 trillion at 3.365% compared to $39 trillion at 5% or 6%. Option 2, cut rates to support the economy and help the government's interest bill. The problem? Inflation is running at 3.3%, and the Middle East conflict is adding to the cost of everything. Cutting rates into persistent inflation unanchors expectations. Bond yields go up, not down, because the market stops believing the Fed will defend price stability. The long end of the curve reprices, mortgages get more expensive, housing freezes, and the fiscal problem gets worse through a different channel. Option 3, hold rates steady and hope. This is what they've been doing. And it's why the debt is compounding at $758 billion per day, while nothing structurally changes. The patient is stable, but the underlying disease is progressing. Option 4, and this is the option the market is starting to price, quiet yield curve control. Buying the long end of the Treasury curve to cap long-term rates regardless of what short rates do. Technically not quantitative easing, functionally identical in its monetary effect. And historically, every time a government has chosen yield curve control to manage a debt burden, the currency has weakened and gold has risen. The last time the U.S. formally capped bond yields was during and immediately after World War II. Gold was legally repriced upward by 70% in 1934 and remained fixed only because private gold ownership was made illegal. This isn't conspiracy. This is the monetary history textbook. Now here's the part that connects the debt spiral directly to the gold price, because most people don't understand how the two are mechanically linked. When the government issues new bonds, somebody has to buy them. For decades, that somebody was a diversified pool of foreign central banks, pension funds, sovereign wealth funds, and private investors who trusted the dollar as the global reserve currency. But since 2022, that pool has been changing. China has been reducing its Treasury holdings since 2018 and now holds around $1.07 trillion, well off its peak. Japan remains the largest foreign holder, but has problems of its own. And the foreign share of total Treasury debt has been slowly declining while the Fed's share has been slowly rising. That matters because when the traditional buyers of Treasuries reduce their purchases, the government has three choices: pay higher rates to attract other buyers, monetize through the Fed, or find replacement reserve assets that other nations want to hold. That last option is the quiet revolution happening in real time. Central banks around the world added a record amount of gold to their reserves in 2023, another record in 2024, and the pace has continued through 2025 and into 2026. This is not a retail trend. This is sovereign treasuries of emerging market nations, BRICS members, Middle Eastern oil producers, and even some traditional Western central banks quietly diversifying away from a dollar system they increasingly view as fiscally unsustainable. They're not buying gold because they think the price will go up. They're buying gold because they don't want to hold the liabilities of a government that's adding $758 billion to its debt every single day. Now watch the chain reaction. More central bank gold buying reduces gold available for private investors. Less available gold combined with rising investment demand pushes the price higher. Higher gold prices signal the market that the monetary system is shifting. That signal attracts more buyers. More buyers require more gold. More required gold means more central bank accumulation. It's the same self-reinforcing spiral you see in any asset that becomes a reserve, except this reserve has a fixed physical supply growing at roughly 1.5% per year, while the debt it's hedging grows at $7.58 billion per day. You can see this in the price. Gold went from the $2,000 range in late 2023 to $5,419 on January 29th of this year. That's a 170% move in roughly 2 years. In the same window, the S&P 500 returned about 30%. Bitcoin, which is supposed to be the new digital gold, was more volatile and delivered lower risk-adjusted returns. Silver surged and then corrected. Gold just kept grinding higher until it hit a wall in January and paused for a correction. The question for every investor watching this video is whether that pause is the end of the move or the middle. Let me put the pattern under a microscope, because history is the warning label nobody reads until they're inside the event. In 1971, the United States closed the gold window. President Nixon ended the dollar's convertibility to gold because the U.S. had spent more than it could redeem, and foreign governments were starting to demand physical metal instead of holding dollars. At the time, gold was fixed at $35 per ounce. Within a decade, gold had traded over $800 and the dollar had lost most of its purchasing power. That wasn't a speculative rally, that was a monetary repricing. The government had printed more dollars than the gold reserves could back, and when the world realized it, the price adjusted. In 1980, inflation hit 14%, the Fed under Volcker raised rates to 20%, and gold hit a peak around $850. That peak held because Volcker was willing to crush the economy to break inflation expectations. He had the political support and the fiscal runway to do it. U.S. debt was under $1 trillion at the time, a fraction of GDP, and rising rates only added manageable interest costs. Today's Fed has neither of those. The debt is 40 times larger. The interest burden is already over $1 trillion per year. The political system is too fragmented to tolerate a Volcker-style recession. And the current Fed chair nominee is going through confirmation hearings where independence itself is being politically renegotiated. Is that proof gold goes higher from here? No, I'm not promising anything. I'm explaining incentives and mechanics, because incentives matter. When the government is trapped between a fiscal crisis and an inflation crisis, and the Fed's 3 good options have all been closed off by the size of the debt, the remaining options all lead to one outcome. The dollar loses purchasing power faster than the market currently expects. And the asset that prices for that outcome, historically and mechanically, is gold. So ask yourself, when the Treasury is issuing $7.58 billion in new debt every day, when interest payments exceed defense spending, when the Penn-Wharton budget model puts the true fiscal gap at $100 trillion, when the IMF warns on April 15th that global debt will breach 100% of GDP ahead of forecast, when central banks are buying gold at record pace, and when the Fed has no politically viable path back to normalization, what does a 10% correction in the gold price represent? An accumulation opportunity or the end of the move? Now let's read the current action like a forensic report. The key clue in the last 3 months is what did not happen during the correction. Central banks did not reduce their gold purchases. They continued. Physical premiums in key markets held firm. ETF inflows, while volatile, did not collapse the way they would in a genuine top. The gold-silver ratio compressed toward historical norms, suggesting metal leadership rather than speculation. And most importantly, the macro driver, the fiscal trajectory, got worse, not better during the correction. The debt grew, interest costs grew. The IMF downgraded its global outlook. The Middle East conflict persisted. Every structural signal is pointing the opposite direction from what the paper gold price is doing. That divergence is the signature of a correction pausing, not a top completing. A real top looks like central banks selling, physical premiums collapsing, ETF outflows accelerating, and the macro driver actually improving. None of that has happened. The opposite has happened. JP Morgan revised its 2026 gold target to $6,300. Yahoo Finance analyst consensus is clustering around $5,500 to $6,000 for year-end. Some institutional models, including the macro strategists tracking fiscal sustainability, are targeting $7,000 or higher in a genuine dollar repricing scenario. The range of serious institutional forecasts is now $5,500 to $7,000, and gold is trading at $4,138. Read that again. The institutional high-end target is 48% above current price. The conservative institutional target is 16% above current price, and the market is pricing as if the correction is a failure rather than a pause. So, here's the cliffhanger. If the fiscal trajectory continues as projected, and there is literally no credible scenario in which it reverses in 2026, the gap between current gold prices and institutional targets has to close. Either gold rises to meet the targets, or the institutions revise their forecasts down. And the institutions are not revising down, they're revising up. Let me put the macro picture in context. Because gold doesn't trade in a vacuum. The Warsh Fed confirmation fight is live. Fed independence is genuinely uncertain for the first time since the 1970s. March CPI at 3.3% puts stagflation on the table. The Iran conflict persists with Hormuz partially blockaded. Section 301 tariff decisions are ongoing. The S&P 500 hit all-time highs in April on AI euphoria, which, historically, before major corrections, is a warning signal rather than a confirmation of strength. And the Trump administration's proposed $2,000 tariff rebate per person would cost $600 billion annually, further widening the fiscal gap. Every one of these factors is gold positive, not because conspiracy, because mechanics. More fiscal stress means more debt. More debt at higher rates means more interest. More interest means less room for anything else in the budget. Less room means more political pressure to monetize. More monetization means a weaker dollar. A weaker dollar means a higher gold price. The chain is not complicated. It's just uncomfortable to think about because the implications are uncomfortable. Here are the 4 signals that matter more than any headline you'll read between now and the end of the year. 1. Monthly Treasury net interest payments. Watch the fiscal year running total. If it's on pace to exceed $1.1 trillion by September, the debt spiral is accelerating faster than CBO forecasts. That accelerates every other signal. 2. The long end of the Treasury curve. Watch the 10-year yield and the 30-year yield. If the curve steepens aggressively, meaning long yields rise faster than short yields, the bond market is pricing fiscal stress independently of Fed policy. That's the signal that forces the Fed's hand toward yield curve control. And yield curve control is the direct trigger for the next major gold leg. 3. Central bank gold purchases. The World Gold Council publishes quarterly data. If Q1 2026 reserves additions exceed Q4 2025, the sovereign accumulation thesis is confirmed. If emerging market central banks begin reporting higher official allocations to gold as a reserve asset, the monetary repricing is underway in real time. 4. The dollar index and the gold price together. When both rise simultaneously for extended periods, which has been happening intermittently since 2023, it signals gold is no longer trading as a simple inverse dollar hedge. It's trading as a reserve asset rotation. That's the deepest signal the system can give you about where the monetary regime is heading. Now I'm going to ask you 2 questions, and I want your honest answer in the comments. First, give me your gold price target by year-end 2026, and commit to a specific number. 5,000, 5,500, 6,300 like JP Morgan, 7,000? Or do you think this resolves lower, back to $4,000 or below? Drop your number, drop your reasoning, no hedging. I want to see how this audience actually reads the fiscal trajectory. Second, if you could force the Federal Reserve to pick one of these 3 options by the end of 2026, raise rates to fight inflation, cut rates to help the debt burden, or implement yield curve control to cap long yields, which would you pick? And what do you think the gold price does under each scenario? This question will generate the most intelligent discussion your channel has ever hosted because it forces the commenter to think through the trilemma the Fed is actually facing. Now, what should you expect next? Expect volatility. After a 10% correction from the all-time high, gold is in a range that will test both sides before the next trend move. It may retest $4,500. It may chop between $4,700 and $4,900 for weeks. Don't confuse that chop with a top. Expect narrative attempts to shake confidence. You'll see them intensify. You'll read articles calling gold overbought from $4,738, a price the same institution said was impossible 18 months ago. You'll hear analysts say central bank buying is already priced in. Ignore them because price doesn't reflect what's priced in. It reflects what clears on the margin. And marginal buying has not stopped. And expect opportunity to appear exactly where fear is concentrated. The $4,500 to $4,800 range will look like weakness to traders and like accumulation to serious holders. The difference between those 2 readings is the difference between trading the move and being positioned for it. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what's happening right now with real numbers from the Treasury, the IMF, the CBO, and the Penn-Wharton budget model. The U.S. national debt has crossed $39 trillion. Net interest exceeds $1 trillion. The true fiscal gap is estimated at $100 trillion. The IMF warned the world on April 15th that the problem is global. Central banks are buying gold at record pace. And gold itself is trading 10% below its January all-time high, despite every structural driver getting worse through the correction. Amateurs watch the gold price. Pros watch the debt to GDP ratio, the interest coverage ratio, central bank reserve composition, and the slope of the long end of the yield curve. The amateur tape says gold had its run. The professional tape says the run is just getting started because the underlying driver is accelerating. Gold is an 8,000-year-old monetary asset that has priced every major sovereign debt crisis in history. It priced the fall of Rome. It priced the collapse of Bretton Woods. It priced the inflationary 1970s. It priced the European sovereign debt crisis. It is now pricing the largest government debt accumulation in human history. And the market is giving patient buyers a 10% discount to accumulate before the next phase. So here's the clean summary. The U.S. national debt has crossed $39 trillion and is compounding at $7.58 billion per day. Net interest exceeds $1 trillion per year. The average rate on marketable debt has more than doubled in 5 years. Penn Wharton puts the true fiscal gap at $100 trillion. The IMF warned on April 15th that global public debt will breach 100% of GDP sooner than forecast. Central banks are accumulating gold at the fastest pace since Bretton Woods collapsed. JP Morgan is targeting $6,300, and the paper gold price just completed a 10% correction that improved exactly none of these conditions. This is where the serious holders of monetary assets separate from the tourists. The tourists watch the price. The serious holders watch the debt. If you want the next breakdown, the moment the debt ceiling fight reopens, the moment the Fed signals yield curve control, the moment central bank gold buying hits its next record, subscribe. These events don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the next move before the headlines do. Drop your year-end gold target in the comments. Tell me which Fed option you'd force them to pick, and I'll see you in the next one.